help us to get through in 30 minutes and give everyone the best experience. Okay, I think we are ready to get started. Okay, well, hello everyone and welcome to Richardson Sales Performance's 30-minute webinar on positioning a price increase. As you can imagine, for many in selling roles, positioning a price increase to their customers is a daunting task. They may understand the rationale and the benefit even to them personally, but it doesn't make that conversation any less nerve-wracking. Yet, there are many factors occurring across all markets that are driving most of the companies that we talk to increase their prices. So we're particularly excited today to share our perspective on this topic and to give you a sense of how to ready and develop your sales teams to successfully gain those higher prices while preserving the customer relationship. Your teams have worked very hard to secure and maintain customers, and continuing those relationships, maintaining that important trust and respect is absolutely paramount. So let's dig in. It's 2022, so we're going to assume everybody here knows how to use Zoom, and we're going to skip all of those instructions. But I will tell you that we're going to hold a quick Q&A at the end of our session. My name is Andrea Grodnitsky. I'm the Chief Marketing Officer at Richardson Sales Performance. I'll be our host today. Joining me are my colleague, Sarah Doherty, our Marketing Operations Manager, and Sarah is going to produce our webinar today. And of course, our presenter, Sonia Duncan. Sonia is our Director of Content Innovation. She works on our product development team to really understand and anticipate the needs for capability development in sales organizations today. She was the driving force behind the development of this program, Positioning a Price Increase, and we are so very happy to have her here with us to present today. Sonia, over to you.
That's great. Thanks, Andrea. Hello to everybody. Thank you for joining us today. So in this webinar, I'm going to cover 4 topics, and then we will open up for some Q&A at the end. So I'm first going to set out our guiding principles for this program, and then walk through the 3 steps of positioning a price increase while preserving that valuable customer relationship. And those 3 steps are prepare, notify, and respond. So let's start with the root of the problem. Andrea's already touched on it. Sellers find these conversations difficult. No one gets up, looks at their calendar, and gets excited about the price increase meetings they have scheduled that day. There's various reasons for that. They may have concern about losing control or upsetting the customer. They may have empathy with the customer's current business challenges, and so on. 3 guiding principles help sellers overcome this natural anxiety. Firstly, prepare to be confident. Research shows that confident negotiators get better results. So good preparation creates more confident sellers, and they achieve better outcomes. Secondly, it's so important that this customer relationship is preserved. That relationship has been carefully built over a long period, and yet it can be badly damaged in one meeting. And then thirdly, position with value. So the seller can move the conversation away from focusing solely on price and talk value with the customer. So the key to positioning a price increase is good preparation and then communicating the value that you and your organization bring to that customer. So why is this such a pressing topic? Most businesses are facing unprecedented disruption from high inflation rates, broken supply chains, raw material shortages. And initially, many customers resisted passing these increased costs on to their customers. Maybe they were hoping things would settle back down, but the reality now is that the resulting pressure on margins means that prices have to go up. The business outlook isn't showing any sign of letting up. Supply chain problems are expected to continue. We're seeing transportation costs increasing due to backlogs, congestion at shipping ports, there's a shortage of container ship space, and so on. Raw material costs are rising. according to just about any of the global price indexes that track manufacturing and production costs. And another big contributor to all of this is the increase in labor costs. Many industries are feeling the effect of the Great Resignation of 2021, and labor indexation alone has been estimated to impact profit margins by 4.5%. Higher costs lead to higher prices. The way that these increases are positioned to the customers is so crucial. Announcing new pricing with little or no rationale is like throwing a bucket of cold water over your customer. It'll probably trigger a similar kind of reaction. And yet, when it's done thoughtfully, agreeing a new pricing structure with the customer can set a solid foundation for greater mutual success. So before we dive into how to navigate this meeting thoughtfully, let's do a poll. So here's the question. How confident are you about your sales team's ability to position price increases with customers? You have 3 options. So go ahead, grab your mouse, click on the one that best represents your level of confidence. All right, so 15%, extremely confident. Sarah, you've shared the results to everybody? Okay. 15%, extremely confident, and that's great. 80%, so quite a sizable majority are moderately confident. Now, you're all coming from different organizations. I'm going to guess that some of that confidence comes down to certain individuals that you feel confident are going to handle the conversation well. Maybe certain product ranges, it's easier to position price increases for customers. Other, where there's more of a commodity type of competition, it's going to be tough to make a case ahead of competitors raising prices. And 5% are not confident at all. The good news is we can help whether you're extremely confident, moderately confident, or not very confident. So let's take a look at how to position a price increase. The first step is prepare. Now you can see there's 3 activities here. Do your research, use that information to analyze your position, and then create your plan. We've defined 4 areas for sellers and organizations to research when they prepare for pricing conversations with customers. On the left side, you see financials and relationships. These are typically internal factors that are specific to that customer. The seller has to dig into their history with the account to understand their position. On the right side, you see industry trends, competitive landscape. These are broader external factors that apply across many accounts. The seller's organization can play a big role here in providing this data so that sellers don't have to do it individually. For internal factors, how long have they been a customer? How much value has been delivered? What contractual terms allow in terms of raising prices? Where are the key relationships? What service issues need to be resolved before we should consider having a pricing discussion? On the external side, looking into things like increasing cost of goods sold, where raw material costs, transportation costs feature. Then what's happening in the market? Is it growing or shrinking? What new opportunities and threats are happening or starting to emerge that may influence our position? On the competitive landscape, what are the customer's options if they look beyond doing business with the seller's company? Can they do it themselves? Who are the direct competitors? What are they doing? How easily can the seller's products be replaced by someone else's? What about indirect competition? Perhaps the seller's products can be replaced not by functional equivalents, but by a completely different approach. Once the seller has completed the research, they analyze their overall position. How compelling is the rationale for an increase? The stronger the position, the easier it is to be confident. The closer they are to selling commodities, the weaker their position is going to be. If the overall position isn't strong, what alternative course of action could the seller take? Is there an opportunity to upsell or change the product mix for that customer to achieve the desired margins? Having done the research analysis, the seller now creates their plan. We step through how to do each of these in our course, and we practice them. I'm going to share a few insights with you today. So the first step is set minimum acceptable price and an anchor price. Minimum price is just what it sounds like. What is the lowest acceptable price you're prepared to agree with this customer? Below that, it's better for you to just walk away and spend your resources on another customer. Once set the minimum price, then it's time to look at the anchor price. This is named after the cognitive bias that you can see here. It establishes a psychological benchmark for the customer. If the seller doesn't set an anchor price and they just go in with brand new pricing, what's the customer going to compare that to? Whatever they're paying today. And those prices may have been set 2 years ago when the world was a different place. The seller has to move the customer away from focusing on the existing price and reframe them in today's economic environment. This includes preparing the rationale to support new pricing. How are they going to showcase the value they provide to the customer? Once they define the rationale, the next step is for the seller to prepare options for trades. We actually don't want sellers to trade. We want them to position the price increase with confidence and strong rationale to get the customer's agreement. But sometimes the customer just won't accept the new terms. So the seller needs options to trade. Now, I want to take a moment here to be clear what I mean by trading. It's about getting something from the customer in exchange for giving something. If the seller just gives without getting in return, that's a concession, not a trade. We want sellers to go in armed with trading options so that if the conversation gets to the point where the customer has heard but not accepted the new pricing, then the seller has options to create a win-win outcome. It doesn't have to be a zero-sum game, but this takes preparation. Sellers should prepare combinations of things they're prepared to give and things they want to get in return. The secret to great gives and gets is finding things that are highly valuable to the recipient, but relatively easy or inexpensive for the other side to give. So at this point, seller has decided on the new pricing, they've prepared the rationale to support it, they've got some options for trading as a backup plan, so next task is to secure internal support. It's critical that the seller knows what they can trade and by how much. Some things will need no approval, others can be agreed by their manager, some will need to go elsewhere in the organization. These generic examples illustrate the point. We can customize these in our training. Some companies empower sellers with high levels of autonomy, others set much tighter controls over what may or may not be traded. It can also vary by sales team, and indeed even by seller. So we've taken a look at some of the activities that sellers should do when preparing to position a price increase. As we close out the prepare step in this session, I want to do another poll. So how concerned are you that sellers are leaving money on the table when they agree new pricing with customers? 3 choices again. Let's see what the group thinks. All right, last few seconds to get your votes in. Okay, so 13% of you are not concerned, You feel your sellers are doing a good job getting what they can from customers? Moderately concerned, just over half. Extremely concerned, around about a third. Yeah, it's easy to leave money on the table. And this seems like a good moment to go back to one of our guiding principles and a point I mentioned earlier. Harvard Business Review found that anxious negotiators reach financial outcomes that are 12% less attractive on average than calm negotiators. Now think about that in the context of positioning a price increase. Are your sellers giving away even 5%, 3% that they don't have to because of their anxious behavior? Let's look at why that is. Anxious negotiators start out asking for less. They set lower minimum price anchor prices. Why leave that money on the table? Their lack of confidence means they concede more easily just to get this whole thing over with. Now, confidence isn't something that just happens or a personality trait that some are lucky to be born with. It takes work. We can set sellers up for success by showing them how to prepare to be confident and having them practice in the safe environment of a workshop. We just looked into prepare. Now let's look at the second step in positioning a price increase, notify. So this is the start of the conversation with the customer. 4 activities you see listed here. The first 2 make sure the customer understands why the seller is there and the value of the relationship between the 2 organizations. Then the seller introduces the new price and waits for the customer's reaction. That's the notify step. At this point, we ask sellers to consider the conversation from the customer's perspective. What is it that the seller wants their customer to think, feel, and do at the end of the conversation? If the customer understands the rationale and feels that the seller is taking a transparent and reasonable approach, they'll be more receptive. Considering the customer experience is key to preserving the relationship. That's the second of our guiding principles. You just saw in that last activity in notify is to stay silent. The seller has just positioned the new pricing and they're ready to hear the customer's reaction. Now, for many sellers, this can be a tricky time. In difficult situations, silences can just last forever. Research suggests that 3 to 9 seconds is a comfortable amount of silence. Now, of course, there are some cultural considerations. Some parts of the world, that window may be shorter or longer. But we don't want sellers to get into a staring contest with the customer. So if you have your chat window open, let's just do a quick chat activity. What's the benefit of staying silent here? Why is this the 4th step in our notify process? So let's have some suggestions in the chat box. Give time to think, allow people to digest information. Customer will fill the silence. Shows active listening. Don't talk yourself out of something. How often has somebody filled the silence answering perhaps a question the customer hadn't thought about? Oh, I love that one. They might just accept the offer. Yeah. If we appear confident, perhaps more confident than we feel deep inside, maybe the customer will just accept. Okay, great answers. All good answers, thank you. So, as you see here, summary. Silence shows confidence. It gives both sides a chance to think, process what's just been heard, and it draws a response. It encourages the customer to speak. That's great. We teach sellers to expect this silence and feel comfortable with it through practice and feedback. And note the second point here, that silence brings better outcomes for both parties. It's not a one-sided thing. So At the end of silence, the seller gets to respond. Now that response has to be based on the customer's reaction, so their activities must flex accordingly. Note that the seller always starts by acknowledging the customer's reaction. Then, depending on what was said, the seller may ask questions to understand the customer's position better. They may reiterate the value of the relationship and the products that they supply, or they may position a trade. Both value statements and trades come from the work that the seller did during the prepare step. They're not made up on the spot. So we looked at preparing trades earlier. So let's jump into when and how those might be used with the customer. First, most important point, don't go straight to trading. Always position value at least once before suggesting a trade. That's our third guiding principle, position with value. Standing their ground and reiterating the value that the seller's organization and products bring to this customer show that the seller is serious about the new price. If the seller's first response is to go straight to trade, it tells the customer they weren't confident about reaching agreement on that price. If the seller has positioned value a couple of times without getting agreement from the customer, then and only then it's time to look at trading. So we also look at how to trade. We can't get into that today, but the point is that sellers should trade. They should give something in return for getting something extra from the customer, not concede by agreeing to those extra benefits without gaining something in return. The science of reciprocity means that offering something, particularly when the seller has stood their ground a couple of times, makes it more likely the customer will agree to the trade. It's so easy to get caught up in the heat of the moment, which is why the seller should prepare multiple trade options, gain approval, and stick to their plan. As we'll see shortly, sometimes it's better to walk away than agree a poor deal, which is often the outcome when trading on the spot. As we just saw, positioning a trade is one of three options for the seller to respond to the customer's reaction. We equip seller with techniques and skills for each of these options and the guidance on when to use which according to the customer's reaction. By this point, participants know how to notify the customer and then respond to their reaction. But knowing what to do is only part of the equation. They also need to be able to execute, and that takes practice. That can take place in a safe space, such as a one-to-one meeting with the manager or a training event, or it can happen live in a customer meeting where the lessons learned can be quite expensive. During the workshop, we have each participant prepare and practice a price increase conversation for one of their accounts. That experience and the feedback they receive sets them up for success immediately after the course. And whether they position value or offer the trade, it's back to silence. From there, depending on the customer's reaction, the seller either loops back to start the respond activities again, or they move on to conclude. One possibility is the seller doesn't reach agreement with the customer. It can be a wiser strategic decision to walk away from an account than continue with the old pricing. Organizations have limited resources. Those that have been spent on this customer could potentially be used more profitably elsewhere. That's a decision to be considered and pre-approved as part of the prepare step. But when the seller successfully positions the value of the relationship to date with the rationale for the new pricing, so the customer accepts the new terms, then the seller concludes with 3 steps. Recap the agreement, confirm next steps, and close by showing their appreciation for the relationship and how they look forward to working together. So that's a quick tour through the 3 steps of positioning a price increase: prepare, notify, and respond, with some insights into both the content and the learning experience. But before we open up to questions, I'm just going to pass back to Andrea. Over to you.
Thank you, Sonia. So Sonia gave you a very nice overview of our positioning of price increase program and some of the key concepts that we teach. Hopefully some useful takeaways for you in, geez, what was that, 25 minutes time. Thank you, Sonia, for keeping it nice and tight for us. Now, there's, of course, more to learn. And if you are interested in building the confidence and skill of your teams in positioning price increases with your customers, we've designed a light blended program offering. So it's available in 2 3.5-hour virtual instructor-led sessions, as well as the option to do some digital pre-work on Richardson's Accelerate Sales Performance platform. We also, with some of our customers, do some real deal coaching sessions post the learning. So if it's a really particularly important customer where you want some of that extra time and help in preparing for that conversation, we offer that option as well. And as part of that program, we also have a planner. I'll just quickly align that for you. It has 3 sections on it. First is prepare. This is where you're going to know what you're going to say. And then notify and respond. This is where your teams can figure out how they're going to say those things during the meeting. I think Sonia did a nice job underscoring how important it is to be prepared, have everything anchored and ready in case you need to trade so that your teams are more confident and skilled in those conversations. One last note before we open it up to a couple of Q&A in our last few minutes here. We do have our next webinar coming up in February. We're going to be talking about the future of sales, which is agile. We're going to be giving you an introduction to our sprint selling program and methodology. That's on February 28th at 11 a.m. Eastern time. We are going to text the link to both that webinar as well as to our website page on positioning a price increase if you'd like to learn a little bit more about the program. Okay, so we have about 4 minutes left and we're going to open it up to some Q&A. If you can look at the bottom of your screen, you should see that Q&A function there. And so we're going to go through that a little bit. And Sonia, we already have our first question from somebody anonymous here, but asking for suggestions for when, timing to present a price increase. Any suggestions on that one, Sonia? You're on mute, by the way.
Sorry, just had to cough. Timing. I think that's a very broad question. I mean, a lot depends on the organization and when you're looking to introduce and how much flexibility the seller has in choosing the timing. I think there's also certain cycles of behaviors in certain industries that make timing perhaps more appropriate in some points than others. But I will say that in terms of how to approach it with your customers, the one piece of advice I would have everybody think about is where you're going to start. So for sellers, it's fair to assume they're going to learn quite a bit from the first few conversations they have about introducing this price increase. So don't lead with your absolute must win or the people that you feel are going to be the hardest to get agreement to a price increase. You know, do your analysis, do your research, figure out, understand the company's business cycle, fit your price increase conversation at a point that's convenient for them, but also works for you in terms of the portfolio of accounts that you manage. Yeah.
Sonia, I would add, you know, as somebody who's been on the buying side and been the recipient of price increases, the one thing I think to stay away from is doing it too late, right before the contract is going to be up. You know, give me a little bit of time. That's the first way to erode trust. I don't think you want too much time, right? But the one thing you don't want to do is just only wait a couple of weeks before the end of the contract. So I just don't think it gives your buyer the time to go back and factor into their budget. And I do think it actually can erode trust as well. We had a question earlier, and there's a couple more here. We'll get to just as many as we can. Sonia, your take, this came in actually over chat a little bit earlier. I'm not sure if you saw it, but your take on whether or not a manager should join a salesperson when they're positioning a price increase to a customer.
Yeah, that's always an interesting question. I think the evidence is clear that sellers tend to be firmer negotiators when they have somebody else in the room with them. It's much easier to concede when it's just you and the customer. So I think there is an argument for providing a little backup. I would say if sellers are going to take their managers, do make sure that their managers are strong negotiators. There's nothing worse than the seller teeing up to stand firm and the sales manager jumps in over their shoulder and offers a concession. So Just make sure you have your game plan, but it can be very effective to have somebody else with you, keeping you honest.
Yes. We also had another question come in, sorry, a little bit earlier. Probably won't have time to get to all of these. Somebody asked if the recording is going to be accessible. It is. We will send you all a note afterwards. So it's recorded and we'll send you the details later. I think Paul asked us actually in the chat. This is a really good question. It might be the last one we have time for. Curious for companies who are not confident in their sales staff by leaving money on the table, how many of those companies are tying the salesperson's compensation to gross profit of the deal? I think we can talk to you a little bit from experience, probably don't have the exact numbers in front of us, but we have a couple of partners who work in sales compensation. And it is a growing trend, absolutely, for organizations, especially now that it's a little bit easier to come with the data in terms of the profitability of any type of customer relationships. We are seeing more and more customer organizations tying salesperson's compensation to gross profit of the deal. I do think it varies greatly depending on the industry. Sonia, I'm not sure if you're seeing anything similar or different.
Yeah, absolutely. I think we've got anecdotes. We don't yet have enough to really call it data, but that certainly seems to be a trend that we're looking at.
Yep. We'll do one more quick question. I know it's at the bottom of the hour, so if anyone has to drop, you can see how you can get in touch with us on the screen, but I know there are still some folks on that had a couple of questions here. So we'll take one more because Ian had, I think, a really good one here. It was mentioned earlier about reasons for price increases from the company's perspective. What if the customer mentions that this is just not justifiable? Compared it off of their current GDP in their country. So the price increase is 10%, but the current country GDP is at 3%. I think the name of the game here is preparation, right? Sonia, this is a little bit about what you were talking about.
Absolutely. I mean, this is a classic case of do your homework, do your research, make sure that you can provide the evidence to support the price increase. And then, if you find a situation where, for example, you're selling a product that's readily substitutable by a number of competitors, they can swap you out and put you in, your competitors haven't raised prices yet, you're looking to get an increase that's higher than the indexes in your country and so on, that's probably not a great opportunity for you to go in and start trying to open up that conversation. So look at your collection of accounts as a salesperson, what you're responsible for, work out where you can get your price increases through and start with those, build your success, build your experience, and then work your way to some of the more difficult conversations. And for those, look at other forms of value. Can you guarantee supply at a premium price? Can you change the product mix? What can you do to change it up so it's not simply what appears to be an excessive price increase?
Yeah. Thank you, Sonia. Two more questions. Again, folks, we know it's 11:33 Eastern time, so if you have to jump, thank you for coming. We'll answer these last two as well. Really good questions from the group here. So best practice as your competition hasn't added the price increase that's being forced from the manufacturer, but you've added the price increase that your selling competitor hasn't. What can you offer there? I think here it's all about the value and differentiation, but Sonia, I'll let you jump in on this one.
Yeah, I think it is. And in today's world, I don't think it's a question of whether everyone's going to raise prices. It's a question of when they raise prices. And so I think there's an argument that says being upfront about it, even when you're the first to go out to the market and say, we're going to put our prices up, you're offering customers certainty. You're offering them a chance to commit to a new arrangement. They can feel comfortable with the supply. They know what they're going to be paying. Whereas your competitors haven't yet announced their price increases. Who knows what they're going to ask for? So I think there's an argument that you can differentiate by being the first to raise prices. And that may sound counterintuitive. If it's explained well, it's certainly feasible. And we have customers that have taken that approach very successfully.
Yeah, and Sonia, I know in the program you talk also a little bit about some of the behavioral science at play of reminding the customer of the risk they take with the unknown. And I think that's particularly important, the fact that they'd have to start over. If you have a good, strong track record of success, the amount of time and investment they will save by ultimately staying with you rather than going back out to market, starting over with it. I wouldn't undersell that value. And again, there's some behavioral science we teach in the program that really hits it, how important that is to your buyers today?
Status quo bias. Yep.
Yes, working in your favor. Okay, our last question here, and I think this goes back to maybe, I'm guessing you're the question about should a manager join the call with a salesperson? So doesn't that also undermine the strength of negotiation, having someone else on? I think that's a really good point. That is a potential risk. What I will say is if you feel like having again, it depends on your industry, and Sonia, I'll let you jump in here too, and the tenure and strength of your sales organization and how important that customer is. If you feel like you need to have a sales manager on certain ones or all of them, yes, it can be a risk. I think the important thing here is that the salesperson is the one that positions. They're the one doing the speaking. The manager is there for additional questions or support. And back to Sonia's point earlier, that the manager and the salesperson are on the same page. The manager should not cave, right? And then make the salesperson look like they don't have any strength in the negotiation, because it will just keep happening in subsequent ones. So I really think it's about the balance of the roles that the two play, but your point is a good one. It can be a risk if you have managers as part of that negotiation.
It also depends a little bit on who you're negotiating with as well. Mm-hmm. If there's just one person from the customer, you putting two people into that meeting can seem a little unbalanced. Mm-hmm. But actually, if you're going to meet two or three people, then it may be much more balanced to have you and a colleague.
Yeah. Great point. Thanks, Sonia. Okay, I think we got to most of the questions. We sure hope we did. Thank you all for hanging in here with us. It was a pleasure having you with us today, and we hope to see you on our next webinar. Sonia, thank you again for presenting.